In the wake of World War II, Japan emerged from its ashes to begin an era of unprecedented economic growth. A nation that had once been devastated by war now found itself on a path of swift recovery and expansion. By the time the 1980s rolled around, Japan had become one of the world's largest and most dynamic economies, an economic powerhouse that was the envy of many. This wasn't just a fluke or a stroke of luck. Behind the scenes, the Japanese government and the Bank of Japan were pulling the strings, implementing policies that significantly influenced the financial markets. With low interest rates and relaxed monetary policies, they set the stage for a boom in the economy. But as we all know, every action has a reaction. And in this case, the reaction was a bubble, a financial spectacle like no other. As Japan's economy thrived, the stage was set for a financial spectacle that would leave an indelible mark on economic history. In the heart of this economic boom, a bubble was quietly brewing. Property values in major Japanese cities, Tokyo being a prime example, started to climb at an alarming rate. This skyrocketing real estate market was not solely a product of a thriving economy, but was also fueled by speculative investments. Many companies and individuals, seduced by the seeming invincibility of the market, dove headlong into these investments, expecting the prices to rise indefinitely. Simultaneously, the Japanese stock market, particularly the Nikkei 225, was experiencing a massive inflation in value. Japanese companies' stock prices were soaring, reaching heights that were not backed by actual earnings or potential growth. This overvaluation was a clear indication of a bubble. The market had become a high-stakes game of chance, with players betting on the continued rise of prices. The bubble, now fully inflated, poised itself on the precipice of a dramatic burst. But what led to this bubble? The answer lies in a mixture of excessive liquidity, speculative behavior, and government policies. Let's start with the Bank of Japan's low interest rates. This was a policy that made borrowing cheap and easy, resulting in an influx of money into the economy, a condition known as excessive liquidity. This abundance of available capital encouraged both companies and individuals to invest heavily in stocks and real estate. Then we have the speculative behavior of investors. Many were convinced that prices would keep climbing, so they bought properties and stocks with the hope of selling them at a higher price later. This speculation added fuel to the already inflating bubble. Finally, we can't ignore the role of government policies. Some argue that the government's policies, or in some cases the absence of regulations, contributed to the rampant speculation and overvaluation of assets. These factors combined, creating a perfect storm that would soon engulf Japan's economy. In the early 1990s, the bubble burst, triggering a catastrophic chain of events. Property and stock prices, which had soared to unprecedented heights, plummeted dramatically. Tokyo, once a city of dizzying real estate prices, saw a collapse that left the market reeling. The Nikkei 225, the barometer of the Japanese stock market, also took a nosedive, reflecting the stark reality of the bubble's burst. This sudden deflation of the bubble didn't just cause a market crash, it led to a prolonged economic recession. This period, often referred to as the lost decade, was marked by sluggish growth and stagnant productivity. Yet, it didn't stop there. Time would reveal that the effects of the burst were so deep-seated that the lost decade turned into lost decades. The banking sector, which had been riding high on the wave of the real estate and stock market boom, was hit hard. Many banks, burdened with non-performing loans due to the collapsed real estate values, found themselves on the brink of failure. Financial sector turmoil ensued, adding another layer of complexity to the already bleak economic landscape. The economy spiraled into a deflationary period, characterized by falling prices and reduced economic activity. This deflationary spiral was like a quicksand, pulling the economy further down. As prices fell, businesses cut back on production, which led to job losses and wage cuts. This, in turn, reduced consumer spending, causing prices to fall even further. It was a vicious cycle, one that the Japanese economy struggled to break free from. In the aftermath of the burst, the Japanese economy, once a beacon of prosperity and a model of economic success, found itself mired in a quagmire of stagnation and deflation. It was a stark contrast to the heady days of the 1980s when the economy seemed invincible. The burst and its aftermath serve as a poignant reminder of the perils of speculative bubbles and the far-reaching consequences they can have. Japan's economy, once a beacon of prosperity, was now trapped in a vicious cycle of economic stagnation. The Japanese asset price bubble was a financial disaster, but it also served as a valuable lesson. This monumental economic event triggered a cascade of financial and corporate reforms in Japan. In the aftermath of the bubble burst, Japan had to confront the harsh realities of its economic policies and practices. The government and the Bank of Japan undertook extensive measures to strengthen the financial sector. Regulatory frameworks were revamped, and financial institutions were consolidated to foster stability and resilience. The banking sector underwent a significant transformation, with stringent checks on lending practices to prevent the recurrence of such a financial catastrophe. The impact of the Japanese asset price bubble was not confined to Japan alone. It sent shockwaves across the globe, alerting world economies to the dangers of speculative bubbles. This event serves as a stark cautionary tale, reminding us of the devastating consequences of unchecked market speculation and excessively relaxed monetary policies. It underscores the importance of vigilance, sound economic policies, and effective regulatory frameworks to safeguard against such economic upheavals. In the realm of economics, the Japanese asset price bubble has been a subject of intense study. Economists, analysts, and scholars have dissected this event, examining its causes, its trajectory, and its aftermath. It has contributed significantly to our understanding of bubble dynamics, the interplay of market forces, and the impact of government policies on financial markets. The lessons gleaned from this event have helped shape economic theories and inform policy decisions, aiding in the prevention of similar occurrences in the future. But the echoes of the Japanese asset price bubble are still felt today. It stands as a stark reminder of the perils of unchecked economic growth and the potential devastation that can ensue. The scars it left on Japan's economy serve as a powerful deterrent, encouraging prudence, restraint, and careful management in economic affairs. The Japanese asset price bubble, a stark reminder of the perils of unchecked economic growth, continues to resonate as a potent lesson for economies worldwide.